Welcome to RBC's Markets in Motion podcast, recorded August 9th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, with reporting season starting to wind down, healthcare and tech stand out positively on a few of our earnings-related sector stats. Second, we recap what we read in last week's S&P 500 earnings calls. The overall tone improved versus the prior week, but we still detected plenty of uncertainty. Third, we run through a few other things that jump out on our high-frequency indicators, including the surge in growth stocks, waning investor sentiment, and the sharp U.S. equity fund outflows seen in the latest EPFR data. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number one. Healthcare and tech stand out positively on a few of our earnings-related sector stats. Over the past few weeks, we've been highlighting how beat rates have been high, but the companies beating consensus earnings forecasts haven't been outperforming the broad market in terms of their immediate stock price reaction. This week, we've dug into those stats a bit deeper, looking at sector trends. Within the Russell 1000, there have been three sectors defining this trend, seeing beats outperform: energy, healthcare, and utilities. Like the broader market, most sectors in the S&P have been seeing positive revisions on consensus forecasts for both earnings and revenues. However, the tech sector has been the strongest on both, followed by comm services and financials. Interestingly, tech is also the only S&P sector where bottom-up consensus operating margin forecasts have moved up recently for both 2Q and 3Q. The overall S&P has seen margin forecasts slip for both time periods. In addition to standing out in a positive way on some stats, the other thing these two sectors have in common is that their tone has generally been a little better than other sectors throughout reporting season. We've been market weight both sectors. Revisions are stronger in tech, but valuations look better in healthcare. Moving on to takeaway number two. There was a better overall tone in earnings calls last week than the prior week, but there's still plenty of uncertainty. We continued reading through S&P 500 earnings call transcripts last week. Similar to the prior week, descriptions of demand varied, with some companies pointing to steady demand trends and no evidence of pull forward, others highlighting their belief that some pull forward has occurred, and others referencing delays due to uncertainty or an elongation of the selling cycle. As reporting season winds down, it's still a bit unclear to us where the balance of risk lies on this issue in the next few months. Several companies that dug into the cadence of their demand in recent months did highlight July recovery, adding to our sense that the overall tone did improve. The consumer-oriented companies that reported last week continued to paint a picture of a U.S. consumer that is resilient yet cautious, value-seeking, trading down, and selective, with pressure on the low end. Overall, the tone was better than the prior week, which we think may be due to the fact that the consumer-oriented companies we heard from last week were more geared towards experiences than goods, which have been more prevalent the prior week. Tariffs remained one of the hottest topics, with companies continuing to describe the situation as complicated, challenging, fluid, dynamic, and contributing to uncertainty. Recurring ideas included bigger impacts in the second half from tariffs, the headwind tariffs posed to margins, the various forms of mitigation strategies companies are deploying, and adjustments to guidance due to lower tariff impacts versus those baked in earlier in the year. A few companies also alluded to hedges that were contributing to mitigation. Commentary from last week's companies continued to point to vigilance on keeping costs down, with a few referring to labor in particular. One industrial company discussed how they need more clarity on the implications of recent tariff announcements before they know what levers to pull on managing impacts going forward, and then noted that so far they've been taking what they called no regrets actions, which have included things that can be quickly and easily reversed. We characterized the first few weeks of reporting season as fine but not fabulous. 2 weeks ago, when more than 150 S&P companies reported, we noted that things got messy. Reporting season is winding down on a better note and still looks fine overall on the stats, but the mess in the narrative that emerged midway through does remain. We think investors and corporates will be confronted with major questions after Labor Day about what the state of demand will look like in the back half, particularly for consumers, how much pre-tariff inventory remains, what levers tariff-impacted companies may decide to pull now that they have a bit more certainty on tariffs, and whether companies will actually start to ramp up capex in response to the tax bill. We'll wrap up with takeaway number three. What else is jumping out? Growth has hit a new high relative to value within large cap on performance. Importantly, the rate of upward EPS estimate revisions has stayed stronger for growth and value and for the top 10 market cap names than the rest of the S&P, highlighting the general idea that earnings sentiment has been better for growth and mega caps. This is important because earnings season has been a time in recent years when earnings sentiment has often faded for the growth and mega cap trades relative to value in the rest of the market. And this has often prompted a temporary shift in market leadership away from those biggest market cap growth names. 2Q25 has been different, however, and the old leadership has remained intact. Meanwhile, net bulls on the weekly AAII survey of individual investors have been hovering around average recently, but fell sharply in last week's update to minus 8.3%. It is unusual for this indicator to fall after only moving up to average levels. Usually the declines begin from much loftier levels. This is a time series that can be volatile week to week, and we'll be keeping a close eye on it in the weeks ahead to see if the deterioration is sustained or represents a blip in the data. For now, the subdued nature of investor sentiment is something we consider to be a positive data point for U.S. equities on a 6 to 12-month forward basis, even if the recent decline points to a near-term pullback. We've highlighted recently how the late summer and fall tends to be weak for U.S. equity funds flows. And right on cue, U.S. equity funds flows saw sharp outflows last week in preliminary data from EPFR. We've taken a look through other categories we track regularly to identify the sources of weakness. What we saw is that this weakness included institutional flows on both the active and passive side last week, as retail flows were actually positive. U.S. equity funds domiciled outside of the U.S. also showed sharp outflows, while flows to U.S. domiciled funds were essentially flat, pointing to likely rotation away from the U.S. by non-U.S. investors. All styles, including blend funds, saw outflows, as did small cap and large cap funds, including, again, both active and passive. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.